Yeah, so this equation is clear. FV minus BV. Mathematically, see, fair value of the acquiry minus book value of the acquiry plus book value of the acquiry minus tax base of the acquiry. It should give me the same. I'll show you, prove it to you with one example. Just look at this example. The fair value, say PP was there. The PP's tax base was 1000 rupees. Book value was 2000 rupees. And when I acquired, its fair value was 3000 rupees. Now on acquisition, if I ask you, is there a deferred tax liability in my CFS? You will tell me, yes sir, 3000 minus 1000, book value minus or fair value minus tax base into 30%. You say there is a deferred tax liability of 600 rupees. So I need to pass one accounting entry. What is my accounting entry? Sorry? Goodwill to deferred tax liability. Because anything coming extra will go and hit my goodwill only, no? So literally we'll say goodwill to deferred tax liability. Alternatively, can I do something like this? See, book value minus 1000 tax base into 30%. This 300 must be already sitting in the balance sheet of the acquiry, no? Before me recognizing, already 300 he must have recognized. I will take the value whatever is appearing in the balance sheet of the acquiry as it is. Now, how much is the extra because of the fair valuation? That is the difference between book value and the fair value. Into 30% if I take, this 300 is on account of business combination. This 300 is already existing. So there are two approaches to calculate the deferred tax on business combination. One, forget whatever is there in the balance sheet of the acquiry. Don't take their deferred tax liability. I just remembered yesterday one more thing. Concentration test. Deferred tax liability we left, no? Why? Because the standard says when you take over liabilities, you have to exclude deferred tax liability. We have to exclude it. This is what standard says. That's why that 180 deferred tax liability we didn't consider in that 800 liability. Anyhow, in our chart also I have updated it. In chart also, in the format also I have told that deferred tax liability has to be excluded. Standard has given that. Deferred tax asset also you remove, cash and cash equivalent you remove. The last one calculation, no? I just told you, I will come back to you. That concentration test. Okay, so now you are clear, no? There are two approaches. Approach number one is ignore whatever is deferred tax is there in the balance sheet of the acquiry. Take your fair value, take the tax basis, straight away calculate. This is possible only when they tell you the tax base. In some of the questions they will not tell you the tax base. But in that case, they would have told you deferred tax liability in the balance sheet. See, both the type of scenarios are there. You cannot say I will follow this approach. In that case, what you need to do, take whatever is available there. Additionally, find out the difference between book value and the fair value, because this represents already these two values are reconciled. The moment you take the acquiree's balance sheet tax, what is that called, deferred taxes, already their book value and tax base is recognized, no, reconciled, right? Now you find out only additional liability. Are you clear about this concept? Perfect, no? Yes. With this understanding, let us move to now calculations and we will solve some problems on deferred tax. Yes, take out your question number 18. This is an MTP question. In March 2018, Pharma acquires Dorman in a business combination for cost of 12 lakhs. How much? Question is silent. I will assume 100%. At the time, Dorman Limited's assets and liabilities were as follows. So they gave you the balance sheet or list of assets. Be careful, you see one item called 300 here. Deferred tax asset 360. Generally, they will give you net. But in this question, this is a list, no. This is not a balance sheet, right? Is it a balance sheet? No, they give you a list. List means they give you the breakup. Now, what is this 360? Where is this 300 came? You don't know. Now, we will go to the solution, further thing. The plant and equipment has got a fair value of 8,000 lakhs. How much is the book value? 7,000 lakhs. and tax written down value is 6,000. What is this? Tax base. The receive, okay. Now, what is your deferred tax? Okay, what is your book value? 7,000. What is your tax base? 6,000. Have they given you the tax rate? 30%. How much it comes to? 300. Deferred tax asset or liability? Liability. So, if I go to the list of asset, then you understand that whatever deferred tax liability in the balance sheet sitting, no, this must be related to PPE differences. You try to understand it. Perfect. That means already they have reconciled it. They calculated it. Trade receivables are short-term trade receivables and net of doubtful debt advance of 300 lakhs. What is this trade receivables? Are short-term trade receivables, net of doubtful debts, allowance of, that means the debtors what you see here, 5,200, how much is as per tax? 5,500. Agreed, no? So your book value of the debtors is 5,200 after RBD. Did that RBD provided? Bad debts are deducted for purposes and not your RBD. So what is your balance of tax base for debtors? 5,500, because whatever deduction you claim, they didn't permit it. Into 30%, how much it comes to? 90. Deferred tax asset or liability? Asset. So I'll go back again. Out of 360, 90 is coming from the debtors. Okay, let us read further now. Employee benefit liabilities are deductible only when the tax is paid. Oh, that means if you see the balance sheet, there is one 900 deferred employee liability provision. What is the book value? 900. What is the tax base? 0. Nice, no deferred tax. Easy, right? Very simple. What is there? On this, 30% comes. How much? 270. Asset or liability? It is an asset. Why? Because it is a liability, no? Tell me. Yeah, where? That's what I'm telling you. See, we did this. Otherwise, no. You said business combination is difficult. Papa, business combination is not difficult. It's a very simple thing. All of adjustments will come from different places now. See, we are trying to figure out. They gave me in the balance sheet deferred tax asset of 360 and deferred tax liability of 300. And they gave me some information. We are just trying to figure out how did it come there. So have you understood that this has come from PPE? Yes. Now 360 has got two breakup. 90 has come from this debtors. Book value of the debtor is 5,200. Tax base of the debtors is 5,500 because the 300 RBD, they didn't permit the deduction. That's why we got a deferred tax asset. Carrying amount is less than the tax base. And there is one employee liability, 900, whose book value is 900, tax base is 0. Why? Because whatever expenses you provided, the income tax didn't provide. They say, when you pay, I will deduct. Since this is a liability, book value is more than the tax base. This is a deferred tax asset, which is 270. Perfect. You got a breakup now. Asset liability. That is a simple logic, no? If it is an asset, book value is greater than tax base, you have a deferred tax liability. This we discussed in 12. So since it is a liability, book value is greater than tax base, this results in deferred tax asset. I told you, you just remember one, you derive all the balance. Perfect? Yes, up to here we are done. Now, because of the business combination, is there anything going to happen? Yes. One thing is, fair value of the PP is going to increase now, more than its book value. That means that 1,000 rupees extra, because book value is 7,000. On this deferred tax is going to come. Plus, Dorman owns one popular brand name which meets the definition of intangible assets under 103. But can you recognize intangible asset brand name? No, that's why you don't see that asset in the asset side. Why? Because it is internally generated asset. No, sorry. Now we get, that's what I am coming to that. As per Ind AS 103, even though since it is an internally generated asset, does it meet the definition of intangible asset? Can you recognize it? Okay, for this we have to consider three things. Identifiable. Is it identifiable? When do you say it is identifiable? Two things again. Is it registered? No, that means it is not legal. Is it separable? Yes, because you can sell only this brand. No, only the name you can sell. Yeah. Can you, is it having future economic benefits? Yes. Do you, have you paid the cost? Yes. You have paid separately for a brand. No. That's why I will recognize it. Independent valuers attributed 4.3 thousand lakhs. It is not 4.3, 4,300. However, the brand does not have any cost for tax purposes and no deduction available. So, what is the fair value? What is the tax base? 0. Is the deferred tax asset or liability going to come? Liability. Is it sitting in their balance sheet? No. Why? Because they cannot recognize it. Is it going to come in CFS? Yes. Understood? No? Now, I have got a two approach. Approach number 1, scrap these two. Take their tax, because tax bases are already given. Take the fair values. Calculate in total, or take these two and take only additional. Have you understood this? The tax rate is 30%, addition, unless otherwise stated, they have got the fair value equal. That means other items, fair value and the tax base is equal. They said don't bother beyond that, cash and liabilities, other things you don't bother. Calculate the deferred tax assets and liabilities from business combination. Don't offset and give me net, show it separately. Calculate that goodwill also, that is accounted on consolidation. 10-mark question. But if you look into this question, the crux or majority heart of this question is deferred tax. Because it is an internally generated. No, you cannot recognize in some, during business combination you can recognize because you are paying money for it. But internally you cannot recognize it. That's why, see, I should have done Ind AS 38 by now. You would have appreciated it better. But Ind AS 38 is filled with more theory. And my priority is to finish these topics first. That's why. Understood? No? Theoretically, I have explained you as and when required. Okay. So, by working note 1, deferred tax on calculation. Solution. Deferred tax on combination. So, first thing, I will split into two portions. Okay, how much is existing and how much is total. You can just follow that format, and if you decide, you can take some other format also. So, I will take a format like this. Fair value, book value, tax base. Wait. Then I have got differences, which can be a temporary difference or it can be a deductible difference or taxable difference. So, I have got a deferred tax asset or deferred tax liability. So, you will write 1, 2, 3, 4, 5, 6 columns. You see, if other pattern or other format or ICA format is okay, you please practice in that way. I will follow this format. What is my PPE? See, first I will focus on what is existing. What is the book value? 7,000. Tax base 6,000. Difference is 1,000. On this deferred tax asset or liability? Liability 300. Then they said all other assets, tax base and book value is same. Then I'll go to receivable. 5,200 is my book value. 5,500 is my tax base. 300 is the difference. On this, what it is going to come? Deferred tax asset is going to come. Then I have got the employee provision, whose book value is 900. tax base is not there, difference 900. On this 270 deferred tax asset is going to come. Since they told me don't offset, otherwise I would have given one column only. Specifically they don't say don't mix both. Deferred tax asset. No? So 360 and 300 is my existing. I'll write here existing. This means these things you can find in the balance sheet of the acquiring. Now PP, how much is the fair value? 8,000. See, if I take existing, is the tax base any more relevant for me? No, I will take 7,000 book value. How much difference? 1,000. On this 1,000 difference, what is going to come? What is going to come? Deferred tax liability, again 300. Alternately, 8,000 minus 6,000 I could have taken. You fix the format. If this is okay with you, do it this way. Then I have got a brand. Fair value is 4,300. Tax base is 0. 4,300. So I have got 1,290 as a deferred tax liability. So I will say that, look, existing I have got asset and liability so much, and due to business combination, additionally due to fair value adjustments, I got this much. So in my consolidated balance sheet, 360 and 1,890 should appear. In SFS, this is what appears, and in CFS, this is what appears. Yes, Prithvi, are you clear? Below 3 is additional because of the fair value. Why? Because income tax didn't recognize it. What about a depreciation is going to, now depreciation is going to come from now, no. When you are preparing consolidation, right now, fair valuation happened at this point of time. So depreciation is going to come in 110. That's what now you will break your head there. Because the moment depreciation comes, your deferred tax reversal is going to happen there at 110. Don't worry, in real life it is tricky. In examination point of view, IC is not going to make your life terrible there. Otherwise, you understand the impact now, how consolidation is. All items, no, you are going to see their face there in the consolidation 110. Reversal of this deferred tax, reversal of another deferred tax, and something happened here in the. That's why you have to prepare the tax reconciliation. Are you clear, students? Perfect. So write note, fair value of other items are equal to its tax base. That means no deferred tax. Bad debts are tax deductible but not RBD, reserve for bad debts. Thus, tax base of debtors is rupees 5,500. See, you wrote there, but you need to tell them. Third, brand name has no cost for tax. Therefore, tax base is nil. Why did you tell? Because there is no tax cost for that. For a brand name, you took the tax base nil. No, why? Because there is no cost for tax purpose. Employee benefits are deductible on payments. Therefore, tax base is equal to 0. So you'll explain everything, why you have taken, because it's a 10-mark question. Don't think, sir, for one working they'll give you 10 mark. And I don't know in exam which verb they will use. They use here deferred tax. I need not write all these stories there. But if they say suggest or something, no, then you may have to write. Last one, on goodwill, no deferred tax. Why? Circular reference, because goodwill is an exception. On goodwill again you will not calculate deferred tax. No, just write on goodwill no deferred tax calculated as per Ind AS 12. Who told you? Ind AS 12 gave that exception. We discussed in Ind AS 12, no, 3 exceptions. So you'll write some theory notes for how do you arrive at the tax base. Brand name does not have this does not have. Okay, next is the goodwill calculation. Right? Calculation of goodwill. What is your purchase consideration? 12,000. Do you have NCI? No. Do you have previous equity? No. Straight away less FVNA. What is your FVNA? How much is cash? 780. Receivable? 5,200. PP? 8,000. First we have got other asset called a brand. How much? That's why I recognize deferred tax. No, my accounting entry will be brand. That's why I'm including in the goodwill calculation now. If I don't do this, my goodwill is going to increase. Instead, I'm taking out one item called a brand. Yeah, Prithvi, any doubts? Fine, no? Yeah, clear, right? Any doubts? Then, do you have anything else? Look at the balance sheet, asset side. Deferred tax, asset, how much? 360. Arre Baba, I should pass that. If you will you take only, see, ultimately at the CFS level, I am supposed to take fair value minus tax base. You got two choice. Either take the fair value minus tax base, or whatever is available in their balance sheet to take plus calculate additional one. But ultimately, what should come is this value, and this value should come. So two choices is take this plus this, or take the final value. So you have got a deferred tax asset of how much? 360. Okay. Now do you have a liability? Minus payable, how much? How much is the payable? Okay, I will write here, okay, next to here. What other liabilities we have got? Please tell me. Borrowing, 4,900. But employee liability not deductible, no? But we are doing goodwill calculation. We are passing one journal entry to prepare CFS. Employee liability is 900. Now very important, DTL. How much? Sure? Yes, we deduct all, we get a goodwill of 2,000. That's what this question is primarily a deferred tax question. Now, if I explain this question there in deferred tax, no, it will be full confusion, because you'll ask me, sir, what is fair value? From where fair value came into picture? Now you appreciate better these questions. Understood? Can we calculate alternatively? Is there any other way? Students, please pause the video. Can you calculate the fair value of the net assets in any other alternative? Please think and tell me. Please pause the video, do the calculation and tell me. Yeah, you are. So now again, why I am asking you this question? Because we may require this logic somewhere else. So other way of calculating is something like this. See, book value of the net assets, you know, already they are given. Take all the assets minus all the liability. You have got what all the differences. There is only one item called a fair value increase in the PP. Add that. Brand which was not there in the book value, add it. And because netted increase in the deferred tax liability, because of all this adjustment, increase in the deferred tax liability happened, net difference or net different because of asset also, you get the same value. See, there are two approaches to calculate this fair value of the net assets. One, take the book value, do the fair value adjustments, or take the individual assets and liabilities fair value. Not required here, you can do any one approach. Are you clear, students? Easy, no? Yes, so we will move on to the question number 19. Next question. On 1st of January 2020, H acquired 100% capital for 15 lakhs. Book value and the fair value of the identifiable assets at the date of acquisition, they are given below. Together with their tax base, chalo, good. I don't have any headache only. They only told me the tax base also. Any goodwill arising on the acquisition is not tax deductible. That means on goodwill don't calculate again deferred tax. Any goodwill arising on acquisition is not tax deductible. That means it's a permanent difference. The tax rates in entity H and S jurisdiction are 30% and 40%. Now who is acquiring whom? H is acquiring S. And S jurisdiction it is 40%, H jurisdiction it is 30%. So which one should I take? When I calculate deferred taxes, I have to multiply with 1%. No, which rate should I take? 30% or 40%? Whatever S has to pay, on that I should calculate deferred tax. No. So for me 30 is not relevant, Baba. Understand? For this, I will prepare one tax reconciliation there. Then I will show these differences because of the tax differences. You remember country A and country B. We have done that. So for me, 40% is relevant because ultimately S will pay the tax. No. So you have got the book value, tax base, fair value. You are required to calculate the deferred tax arising on the acquisition. Also calculate the goodwill on acquisition. Can you try this? Easy, no? And do you need to give the breakup here? How much is already sitting in the balance sheet? No, because balance sheet they didn't tell you. If balance sheet information was available, you would have tried to give the breakup of that and say that this is already existing and this is new. Here, book value you need not consider, no. Straight away you can take these two differences. When you wanted this book value, if already in the balance sheet some taxes was available, then you would have taken book value to tax base. First do that and say this much difference. And then additionally fair value to book value, this is the difference. You would have done that. Why you want to get into the book value now? Ignore it. Straight away start two columns called the fair value, tax base, find the difference and tell me the amount. That's it, no? Before you proceed. Or you can write it afterwards also. You have to just write one theory that on goodwill, no deferred tax, tax rate of 40% is considered, which is S jurisdiction. Because whenever the temporary differences are going to come, who is supposed to pay the tax? S is supposed to pay tax, no. So you are going to say that we are going to consider 40% tax, which is of S jurisdiction, not your piece jurisdiction. So one small theory, if at all, since they use the verb called calculate, I don't know how much relevant. Yes. So please calculate the deferred tax assets and liabilities. And you need not have two different columns here, deferred tax asset and liability. Why? net, because question is very silent. No? Have they told you don't offset it? No. So you can have fair value, tax base, temporary difference, deferred tax, whether asset and liability together. One column only you can give. Yes, we'll compare the answers. So you have got a land and building whose fair value 700, tax base 500. So you got a deferred tax liability. PP, again you have got a deferred tax liability of 28. Inventory, you have got a deferred tax asset of 8 because your book value is less or fair value is less. Trade receivable, CC, payables, you don't have anything. Retirement benefits, you have got a deferred tax asset of 40. So total net assets 1060. So fair value of the net assets is 1010. Because already you have got a fair value 1070 plus additional 60 deferred tax liability. Did you get this? Fair value of the net assets. Now, what is the goodwill? 1500 is the purchase consideration, net assets is 1010, 490 is the goodwill. Yes, anything happened? Any mistakes? I would like to discuss. Yes, Vidya, what happened? Deferred tax liability, will you is a liability? No, this is net asset. Is it a positive asset or a negative asset? Plus. So from a net asset, liability will be deducted. No, you have taken a borrowing, liability. No, Papa. No, don't add that. When you talk about, see, this is net assets fair value excluding deferred tax. This should be always part of the fair value of the net assets. The deferred taxes, what is going to come, no? It should be part of wherever. If you want to present, you can present it like this also. See, fair value of net assets, FVNA other than deferred tax plus deferred tax minus deferred tax liability. You can present it like this also. But don't show as part of the purchase consideration. It's not a purchase consideration, no? If you want to present it here, bottom. I am okay with that. I think you must have shown it at the top. Here 2 times you did minus. No, what I suggest, do it in the inner column. Show one item out there at the out. Perfect, understood? Yes, Vishnu Priya, no mistakes? Yes, now one more question. Actually this question is in India's 12. So I have got that India's 12 question here. On 1st April 2011, A Limited acquired 12 crore shares representing 80% of B. How? By paying 25 crore rupees cash. Now it is the group's policy to value the NCI at the date at fair value. Understood? The market value of the equity instrument in B Limited at 1st April 2011 can be used for this purpose. Yes, because NCI should be valued at acquiree's share price only. On 1st April, the B Limited value was 2 rupees. Okay, so with this we know that we can calculate NCI value. Purchase consideration they have already given. No step acquisition. So that means first portion we are done. Now let me talk about the fair value of the net assets. On 1st April, the individual's financial statements showed a net asset of 23 crore. Oh, they didn't give me the breakup this time. They showed me the net asset value only, book value only they showed. Maybe it is sitting with the deferred taxes also, God knows what it is there. They have not told me the net breakup there. So this time I cannot take the approach of fair value minus tax base. I am forced to go with the tax base minus fair value minus the book value. The directors of carried out the fair value exercise to measure the identifiable assets. A property having a carrying value of 15, estimated market value of 18. That means this 15 is part of this 23. What other assets are there, I don't know. But this is, I am going to take it 18. Plant and equipment having a carrying value of 11 had an estimated market value of 13. Again, same story. Okay. And inventory in the books shown at a cost of 2.5, the fair value is 3. That means, see, total net book value is 23. 23. Have they told me the breakup of this? No. But they told me one thing. There are 3 items whose fair value was not equal to its book value. Which all those? Property, PPE, inventory. For these 3 items, individually they told me what was their fair value, what was their book value. I add them all. I will not get 23 because God knows now what other elements are sitting there. Borrowing, God knows which all items are there. So I have to go to an approach now where book value minus fair value plus net book value. You remember I told you alternatively can you calculate? That we have to adopt for this problem. Otherwise there is no choice only for me. The fair value adjustments are not reflected in the individual statements of B Limited. That means in the B Limited the book value is 23 only. Fair value means they did not revalue and all. If at all it would have reflected there, then book value was equal to fair value. In the consolidated statement, the fair value adjustment will be regarded as a temporary difference because we don't know, maybe this is a permanent difference, God knows. They helped us, they said it's all temporary difference for deferred tax purpose and you multiply with 20%. Calculate the deferred tax impact and calculate the goodwill. Okay, so first we will calculate the deferred tax. Working note number 1. Calculation of deferred tax. So we have got property. We can straight away do here instead of writing the columns. 18 minus 15, agree? Into 20%. I am going to get asset or liability? 0.60 deferred tax liability. PPE, same story, 13 minus 11 into 20%, 0.40 deferred tax liability. Inventory, how much is my inventory? What is the fair value? Book value? Yes, Prithvi, you have any doubts? Tax base doesn't come into picture because they didn't tell me the tax base. No? So I am assuming that 23 includes deferred taxes also. So therefore, for me, tax base is equal to book value. And I will compare the fair value with the book value. So because of the fair valuation exercise, how much is net DTL? 1.10. Okay, they asked me calculate the deferred tax. I said this is my deferred tax. If you want, you can write some theory, but not much relevant because they said calculate. Others you said okay, book value is 23 and only 3 assets are fair valued, because of which the temporary differences are going to come. Not relevant. So you say that my deferred tax will be 1.1. Now we will calculate the goodwill. For goodwill, I need the fair value of the net assets. So you prepare working note number 2, fair value of net assets. Can you tell me what is my fair value of the net assets? Sorry, yes? Yes, students, others? Please, students, please pause the video and tell me what is the fair value of the net assets. You can pause the video and do the working, whatever format, okay, doesn't matter. Answers, let us compare. You know, when you make mistakes, you will remember it better. Answer is 27.4. Why? Because you start with the book value, you don't have any choice. For this book value, you add the fair value adjustments. In fact, how much fair value increase has happened. For this deferred tax liability, you are going to deduct. You get 27.4. Yes, what mistake happened? You took only up to here, not the deferred tax. Huh? Understand? We have to take deferred tax. Previous question we have taken, no? Because this is also part of business combination. Yes, what happened? Book value you didn't consider. Only fair values you took, huh? No. Because what about other liabilities and all? There can be a debtor. Do you think this business doesn't have a debtor? Doesn't have a cash? No. That's why we have to take this approach here. That approach worked first time because they gave me all the breakup there. So understood in 2-3 ways how they will give you different cases. So these are all small cases which can, on a standalone basis, this can come for your exam. Alternatively, in one big problem, this can be one of the component. See, now it is like a plug and play. You have learned independently purchase consideration, so there can be any combination. You have learned NCI, you have learned about the step acquisition, you have learned about the fair value, deferred tax coming there, indemnification asset. So any permutation and combination is possible. You have to think individually. Don't look at whole problem, because any problem is made up of small concepts. Do you have a hold over that small concept? Yes, you can integrate it. That's what you should learn. Yes. If you see the ICA working, no, they have done it like this. See, ICA has done this 23 plus this, and deferred tax, no, they have calculated here only. See, finish. In one line, they have calculated deferred tax. In fact, I told you during deferred tax class also, for deferred tax calculation, there is no format as such. You can do it anyway once you have understood, no? Because tax book values, they have taken only net increase into 20%. Followed, no? Now, goodwill calculation, you have done? Yeah, 25. NCI is how much? 6. 12 crore number of shares for 80%. 20% how much? Into 2 rupees per share. And FBNA working note 2, so you will get a goodwill of 3.6. Anybody got any different number? Huh? Why? Did I read the question fully? Huh? No. Did I read the question fully? In that question, there were 2 questions, no? Calculate deferred tax, see, again, yeah, mistake. I will say it is a pure mistake. See, in exam also this may happen. You are too much focused on one thing. Again, go back and see whether have you answered everything. Because it can be just, this will fetch you 2 marks or maybe 1 mark. Don't you want 1 mark? Every single mark is important, no? And this is simple actually. You would have got just like that. That's why it's very important. Go back again, check every single question after you are done. Have you addressed everything what they have? Don't give more than what they are asking. If they say calculate, don't write any theory. Just calculate and do it. They don't want anything extra, but not less also. Okay, clear? I'll proceed further. Yes, now we will talk about the measurement period adjustment, a small theory because it can be a part of one problem. Yes, so before we proceed into the measurement theory, see, we have finished with the format and this is your format of calculation. See, we have got purchase consideration, which includes cash, equity shares, non-financial assets, a retail business, deferred consideration at a present value, contingent consideration at fair value, pre-combination only replacement awards. Purchase consideration excludes, if included only, payment to the employee shareholders, settlement of relationship and reimbursements. Fair value of the previously held equity and the amount of NCI plus non-replacement awards, pre-combination and vested, minus fair value including deferred taxes. If you do this, you get the goodwill. So this, any question when you solve, look whether these components are there, and this is nothing but a journal entry. So what is this measurement period adjustment? See, understand students, the goodwill what you calculate, it can never increase again. It's only one time. Okay, but it can reduce. No, it may increase also because of only one reason. It is called See, it will decrease because of two reasons called impairment, but it may increase or decrease because of another reason called the measurement period adjustment. Now, what is this measurement period? Say you have done acquisition on say 20th of March. By 30th, 31st of March, you have to finalize, you have to prepare a CFS, but you don't have much time there. You didn't get every information. That's why there is something called a measurement period window, where you can gather all the required information to prepare the CFS, price allocation, etc. Till that time, you can do it on a provisional basis. It's like a provisional balance sheet. You didn't have time, no. Hardly 10 days were there. And by the 10 days, you have to prepare a CFS. And do you think all the information you will get? And this period is 1 year from the acquisition date. That means, in the month of February, you purchased. Say 1st February or say 28th of February you purchased. Your measurement period will go up to next year, February 2023. That means during this period, if you come to know any new information which was existing on February 22, but you didn't knew at that time. Since you didn't knew at that time, your goodwill went down or goodwill went up. Now you can do a retrospective changes to goodwill. But if you come to know any new information in between, no. If it was not existing here, you can't do retrospective, you have to do prospective. Alternatively, in the month of March 23, you come to know there was one information in February 22. Nothing doing. You have to take it to P&L account only. So anything which was existing here, which you will come to know within next 1 year of its acquisition, you can adjust it back to the goodwill with the retrospective effect. This is the concept of measurement period adjustment. And this is the last aspect. With this, we can straight away come to the calculation problems, big problems. During the measurement period, you can retrospectively adjust provided it existed on the acquisition date, not later. If it happens later, then it is accounted as per Ind AS 8. Are you clear? Yes, we will solve some 2-3 problems on this. There are some 2 theory questions are there on measurement period adjustment. Yes. Yes, we get 1 year time. Sorry? That's what. See, now I have to prepare the financial statements here. Now this is called a provisional financial statements. So I'll do it. On March 22, sorry, not 23, 22. I have to change this. This is 22. I have to make a provisional basis. Now, if at all I will come to know somewhere later, no, I will change the goodwill of March 22. That means I'll show how it comes. No, we'll solve one problem. We will get a better understanding. But without measurement period adjustment, you will never touch goodwill unless it is impaired. So only thing which will reduce your goodwill is the impairment other than measurement. And measurement period adjustment is only for 1 year. And it is capable to increase the goodwill or decrease the goodwill. Okay, no? Understood the concept? Yes. So now let us go back to the theory questions. Entity X acquired the 100% shareholding on 1st April and completed the preliminary purchase price allocation, etc. Recorded the net asset of 100 million and purchase consideration of 150 million. So how much is the goodwill? 50 is the goodwill. Now entity Y has got significant carry forward losses on which deferred tax asset was not recorded due to lack of convincing evidence on the acquisition date. You know, when deferred tax asset comes, 3 conditions you need to test as per 12. That means, okay, you have got a carry forward loss, but are you going to get the profits in the future? No, that's why the subsidiary Y did not recognize it. That means in your balance sheet there is no deferred tax asset the day I took over. However, on 31st March 2012, that means within 1 year from the acquisition date, because you acquired on 1st April 2012, exactly on the last day of the measurement period, entity Y won a significant contract because of which we think that future income is available. And now you want to recognize the deferred tax asset. Can you recognize deferred tax asset? Can you recognize deferred tax asset? Yes. Understand the difference. Can you recognize deferred tax asset? Yes, as per Ind AS 12. Now, when you recognize deferred tax asset, what accounting entry you are going to pass? One like I will tell, deferred tax asset account debit to what? To what? If we are in Ind AS 12, what entry to? PL. You would have said P&L. Since we are into business combination, you would have said, sir, to goodwill. But I say measurement. You say we are within measurement period. No, we are not. Even though we are within measurement period, this contract we won now, this condition was not existing that day. If already that contract was available, we didn't knew it. Then it will go to goodwill. Because this is not a measurement period adjustment, because condition was not existing on the day you took over. Imagine this contract was already there. We didn't knew it. Then it is a measurement period adjustment. I'll go back and I will credit to goodwill. Not clear, Vishnu Priya? See, okay, I'll read the solution, then you can understand, try to understand. Ind AS 103 permits changes to the goodwill if it is measurement period. That means within 1 year, if any change you want to change the goodwill, you can change it up or down. But due to discovery of fact which existed on the acquisition date, you understood, you found out something new. When? Later. But it was existing on that day. However, if any fact changes after the acquisition, even though it is less than within measurement period, you will not treat it as adjust it to the goodwill. You will adjust as per accounting standard, whichever other standards will say. And in Ind AS 12 says, take it to the P&L account, deferred tax assets. So in the given case, you are not eligible for recognition on the acquisition date because there was no taxable profit and the new contract came later only. So it is not going to impact the goodwill. You will pass the entry, deferred tax asset account debit, you will recognize it because you got the contract now. But the credit you will not take to the goodwill, you will take to the P&L account. Why? Because it is not that measurement period has finished. Measurement period is there, but this condition was not there on that. Are you clear? That if we were not aware and now we come to know within 1 year, then it would have been deferred tax asset account debit to goodwill because simple, logic is simple. If I knew on that day only, what entry I would have passed? I would have recognized deferred tax asset that day only, no. And the moment I recognize deferred tax asset that day, goodwill will come down. How? It is contingent, but are you, see, if you get a contract, can't you use your carry forward losses? Because you are going to earn taxable income, no. What your Ind AS 12 says, if you have got a carry forward loss, on which deferred tax asset is going to come, because book value is zero, tax basis loss. But before recognizing deferred tax asset, 3 conditions you need to check: taxable temporary difference, future profits, tax planning opportunities. So we have got to take future profits. New contract means future profit. Are you clear? Yes, one more question. Very nice question, and I will consider it a very important question. Please understand it very carefully. ABC acquired XYZ in a business combination on 15th of January. So you can, rough book, you can note down the dates. 15th of January you acquired for 100 crores. Fair value of the asset acquired is 70. So how much you acquired? 100%, no? So maybe 30 is the goodwill. Few days before the date of acquisition, one of the X Limited customer claimed certain amounts under some penalty clause for the delay in the contract. Just before few days acquisition happened, no, there was some claim from one customer. These people kept quiet. It's a contingent liability for me. Now ABC evaluates the dispute based on the information available at the date of acquisition and concludes that XYZ is really responsible at least for some delay. Based on that, they recognized a contingent liability of 1 crore. What entry they must have passed? Who recognizes now? ABC at CFS. Can you recognize contingent liability? Yes, because of that exception. What entry you pass? Goodwill to contingent liability. So by 31st March 2011, you have got a goodwill to contingent liability for 1 crore, which is estimated to be the fair value. So 1 crore you must have recognized. Now in October 2011, is this within the 31st October 11? Is it within the measurement period? Yeah, because your measurement period ends 15th of January 2012. Now the customer presents additional information because of which you conclude it is not 1 crore, it is 2 crore. On which day? On the acquisition date. Because there was information but you didn't know. Now customer is telling you. These people didn't tell you that at that time. Is it a measurement period adjustment? What entry will pass? Goodwill to which goodwill? This retrospective goodwill. So 31st goodwill you are going to change now with retrospective effect. ABC continues to receive the information after October also. Its evaluation does not change till February. So in February you finished with your measurement period. 15th January was the last. After the measurement, now it came to know that the fair value liability was not 2, it was 1.9. So now you realize after measurement period that at the date of acquisition, which somewhere in the October you retrospectively restated, no, that is not even 2, it is 1.9. But nothing doing now. You cannot go and touch goodwill again. That what you decide after measurement period 1.9, it is no more relevant because it's gone, closed history. Now determines that the amount to be recognized as per Ind AS 37 now is how much? 2.2. This is important to me. Right now, what is the value? 2.2. After measurement period, what was there on the acquisition date? What you have to do? Nothing, no? How should the adjustment to be made, provisional amount to be made in the financial statement during and after measurement period? So I have plotted it. On 15th February, there was a liability of 1 crore you provided. 31st March, you accounts finalization happened. On this date, the liability came 1 crore. Now 31st October, it was within liability measurement period, you made it 2 crore. Now on 28th of February, after liability but on acquisition date, irrelevant, not required. I will cancel this with red color ink. Why I need Baba? Now on 28th, this date it is 2.2. Have you understood the flow? So now question comes, how do you adjust this? So you have to write a theory. You have to say that, look, on 31st March, the CFS will show a contingent liability of 1 crore along with the goodwill of 1 crore. Now, what is your goodwill here? Goodwill is 30. 30, no? Which is 100 minus 70. When the customer represents additional information, incremental liability of 1 crore will be adjusted to goodwill because it is within the measurement period. Now, entity need to disclose that information in the comparative also, because last year it is a retrospective change, no? In comparative also you need to change, and any information of decrease after measurement period, it should be ignored, not adjusted to the goodwill. And anything subsequently should be adjusted as per Ind AS 37. So already you have made a provision of 2. Now it is 2.2. So 20 lakhs should go to P&L. So this is the answer what you need to present in your examination if this question is going to come. Understood? Now let us understand from the journal entry perspective. On 15th of February, you must have passed this entry, net assets account 70, goodwill 31, bank 100 and litigation liability 1. Now you must have prepared a balance sheet on 31st March 2012 like this: net asset 70, goodwill 31, contingent liability 1. You would have presented a balance sheet like this. Now 31st March 2012, you will retrospectively pass one entry on 31st October, where you debit goodwill, credit liability. And on 31st March 2012, you will debit that extra amount to P&L account. So now you prepare a balance sheet on 31st March 2012. Look, what was your net assets of the subsidiary? Let's, for simplicity's sake, let us assume it is same. What is your goodwill now? 32. How did you get 32? 31 opening plus 1 retrospective entry. Understood? What is your last year? 31. But since you gave a retrospective, your comparative also you are going to change, and you will give one disclosure: measurement period adjustment of 1 crore was done. This is what they say in the answer. So information resulting in the decrease shall be disclosed. That the comparative information, you have to give the disclosure along with the explanation. So when you retrospectively change, you have to say that so and so happened. And customer litigation also you will say the same thing. Because if somebody opens the last year P&L account, no, or balance sheet, they will say only 31. Clear? Yes. Bank F acquires E in a business combination. The loan by Bank E to the borrower B is recognized previously provisionally determined fair value. There was one borrower was there. F is the acquirer, E is the acquiree. E has given one loan to B, and you took over at a determined value. Now in the month of December, when you acquired October, is it within measurement period? Yes. F receives the financial statement for the year ended 30th September, which indicates that there is a significant decrease in the borrower's income from the operation. Basis is the fair value of the loan is determined less than what you recognized earlier by say 10 lakh, and this time in the new syllabus they striked off this 10 lakh. Is this the measurement period adjustment? Yes. Why? Because when you took over, you valued this customer, but you didn't know that this customer is the bankrupt. Now you come to know today within measurement period that on that day only he didn't add money. Scenario 2, same story. In December you come to know there is an earlier major customer in that month only expected to have a negative effect, because of which loss came 10 lakhs. Is it a measurement? No. Why? Because on the date of this event happened after the date of acquisition. So you see that new information came, so you have to adjust goodwill. New information came after the acquisition date, so you have to account it as per 109. Clear, no students? Yeah, there are some problems we will solve now on the measurement period adjustment. Then we can take a break and move to the bigger problems. Yes, this is my example. Even though you don't solve also fine. If you sit and understand also fine. A Limited acquired 80% of B Limited for cash of 100 crores. Fair value of the assets is 80 crores. What is my goodwill? Be careful. Because you didn't 100%, no, then you would have said 20. So no goodwill. Now on 1st of May, A obtains certain information about some customer relationship which existed on 1st of March on the date of your acquisition, whose fair value was 10 crore. What do you mean by customer relationship, and which he did not obtain due to limited in time? There was no time. What do you mean by customer relationship information? Yeah, I want to get everybody's opinion. What did you understood with this sentence? I am very friendly, okay? I will tell you with beautiful words which you understand like this. Institute may use this type of terms in the examination. If you suddenly come across this, from this sentence, you tell me what did you understood? What was there? Exactly. What was there? Huh? Customer was there or customer relationship was there? What do you mean by customer relationship? Huh? Yeah, you are right. Customer relationship means brand. Dorman, have we discussed some time back? Deferred tax. So a Dorman question can get converted, and instead of brand, they may use a word called a customer relationship. Don't get confused in the exam. Customer relationship means you had got a brand. And that's what I want to see, because in exam also you may think differently, no, if this type of words come. But have they told you any obligation and all? Because your misinterpretation will change. Instead of an asset, it will make you to a liability. Goodwill is going to change. So understood, no? What is customer relationship? You had a brand, you didn't recognize the brand. If you knew, what entry you would have passed? Brand to goodwill. You didn't pass that. On 1st of May, A learned that due to additional customer relationship being developed, the fair value of the such relationship has increased to 10 to 12 crores. Will you pass that additional 2? What entry will pass for that additional 2? Post acquisition. Then that means Ind AS 30 is going to be applicable, and say internally generated brand is not to be recognized. So you ignore it. On 28th of February 2011, is it within measurement period? Yes. A concluded it has obtained all the information, no more information will be required. Calculate the goodwill on the acquisition date and pass necessary journal entries. Where NCA is valued at net assets, NCA is valued at a fair value, and the fair value being 20 crores. Followed? Yes. Tell me, students. Okay, first of all, I missed. Do I have any goodwill here? See, understand. I also made a mistake along with you. We should not take 80% of 100. When we compare 100, 100% is for 80% of the value, no? You have to take 80% of the net asset if you want to do that way, net on net basis. Because this is 100 is for 80% of the asset. How can you compare 100% of the asset? I also made the same mistake along with you. I also took 80% of this and compared and said no goodwill. No, there is a goodwill. No. So students, can you calculate the goodwill and pass the entries? Okay, anyhow, we can do this. No, you can practice it later. We'll just check it. So my goodwill will be, purchase consideration is 100 in both the cases. NCA will be 20 if you follow fair value, otherwise 80 into 20, 16. And your fair value of the net assets is 80, 80. So 40, 36 is your goodwill. This is when 1st March. Did you knew that brand was there? No. If you come to know that there is a, okay, and what entry? This is what you would have done. You would have passed one accounting entry. What accounting entry you would have passed? Net asset account debit, goodwill account debit, say 40 or 36, whatever, to purchase consideration to NCI. Now you come to know on 1st of whatever, March or later, you have to pass one accounting entry. What entry you would have passed? Retrospectively. Brand account debit. Okay, so you would have passed the entry. Customer relationship account debit 10. To goodwill 8. Since you have followed partial goodwill method, see, if you knew on that day NCI, you would have valued less. No. So you will reduce NCI also. Have you understood this logic? See, this is an example. You need not record it because later again we are going to come across in one problem this particular thing. Have you understood here? See, if you knew on day 1 Because in all our previous adjustment, no measurement period, we were 100%, 100%. But in this particular problem, we are 80%. If I knew on day 1, I would have not valued NCI at 16, right? Mad or what? Because my net assets are more than that. So I would have increased NCI also by 2 crores. If I would have followed full goodwill method, my accounting entry will be customer relation to goodwill. Why? Because that fair value of the net asset has no role to play for valuation of the NCI. Understood? Understood? Everyone understood? And what about that additional 2 crore? Ignore it, because it's an internally generated goodwill. CFS? No, because it's internally generated. 10 crore I am going to recognize. I am recognizing I am going to reduce the goodwill by 8 crores. Acquirer acquires one acquiry. Acquiry had a brand. I didn't knew it. So previously it increased, because if I knew on day 1, I would have made this 90. The moment it is 90, my goodwill would have come to by 10 down. So the same thing I am doing right now. I am reducing my goodwill. But when I am reducing the goodwill, question comes, which method of NCI evaluation I followed. If I had followed a partial goodwill method, on day 1, when I know my fair value of the assets are more, I would have valued NCI by more, no. So my accounting entry will be this. If it is the full goodwill method, my accounting entry will be this. Are you clear? Yeah, please discuss. Huh? Again, which 12 you are talking? So I will go back to the question. Are you talking about this and this? Yeah. On acquisition date, when 1st of March, you acquired a brand. Its value was 10 and you didn't knew only. Afterwards, who started to give service? A Limited. Now, B only gave service to the customers, but under the instruction of A Limited. Now, A Limited is highly quality conscious. Because of the better service to the customer from 1st of March till 1st of May 2020, the goodwill again increased more than 10 to 12. It was, but I never recognized. I didn't knew only. Neither my acquiry recognized. Acquiry cannot recognize only, because as per Ind AS 38, acquiry cannot recognize internally generated goodwill. At least he should have told me, sir, look, sir, I have got a good name in the market. He kept quiet. So I never took it for valuation of the business or what valuation of the goodwill. Now later I will come to know. So this is a measurement period adjustment. I would have recorded 10. On the same day, I came to know that there is actually this is 12. When today, this is 12 is when on 1st May. On 1st March 2020, how much? 10. So today, retrospective entry when I pass, will I pass for 10 or 12? I have to pass for 10. Why? Because this was existing on that day. Now, will I pass additional? No. If you refer the previous question, we passed additional 20 lakhs. Why? Because it's a liability. Why I didn't pass? Because it's an internally generated brand. That's why I didn't pass. If you refer the previous question, on the acquisition date it was 1, I made it 2, I adjusted this difference 1 to goodwill, and at the end of the first year it was 2.2, additional 2 I charged to P&L, 0.2 I charged to P&L. Why? Because it's a liability. I have to pass the entry. But in this case, on acquisition date, I recognize nothing. On 1st May, I come to know, so I will recognize 10. Today's day, it is 12, but to 12 I will not consider because it is an internally generated brand. So I will just adjust 10. But when I do this, I will consider which method of goodwill valuation I have done. If I had have done partial goodwill method, my accounting entry is not customer relation to goodwill. I will take only 8 crores to goodwill and balance 2 crores I will take to NCI. Because if I knew on day 1, I would have increased NCI by 2. No. Will they keep quiet? They will sit on my head there. The day, if one or the other day, they will also come to know. So they will come running, sir, what's this? You have valued us less. You should have valued us more. If it is a full goodwill method, they don't have any choice only, no. Because I am valuing them based on the fair value. So entire amount will go to goodwill, which has got 2 portions. 8 belongs to me, 2 belongs to NCI. Are you clear? Have you understood this concept? Because later I will ask you one journal entry. I will not explain you again. And I expect you to give a proper journal entry. That's why, see, I am spending time to discuss here, explaining you again and again. Because this concept is sitting in one big problem. You miss it, problem is gone. Next question number, one more, same question. Another version. A Limited acquired 80% for 100 crore, 80 crore on 1st of March. Now on 1st of May, you come to know that there is one customer litigation. Fair value was 5 crore on that day. Today you come to know. And the day you come to know its value is 7 crores. And you decided that everything has been done. Now students, can you pause the video and pass the journal entries for this? Since you have understood the, if you want, you can please pause the video and pass the journal entries for the previous also. It's just a journal entries, no? So you can pass the journal entries for this. Yes, students. So we'll compare the answers. So your goodwill to calculation remains the same, 4036. So, and if you would have followed the partial goodwill method, you would have debited goodwill 4, NCI you would have debited 1, 5 crore into 20, and contingent liability at a fair value 5. And under full goodwill to contingent liability at a fair value. And now additionally you would have passed that entry. See, if that depends upon, if you treat it as a contingent liability, you will disclose it. But if you treat it is like a provision as per Ind AS 37, if it is a probable, then additional 2 crore you will pass the entry P&L account debit to whatever provision or contingent liability. Perfect. Understood, everyone? Anytime? Normal, our normal accounting, whichever standard, Ind AS 37 or whichever accounting. But during measurement period, if and only if that information was missing on the day, then it will be retrospective to the goodwill. If this was not there, it would have gone to P&L account straight away. Sorry? Existed on the date of acquisition. Clear, no? Yes. With this, we are done. Yes. Now we will start with the beautiful, important, compulsory questions, generally which comes as a compulsory question. No? First question, we will solve that.